Let's jump straight into this explainer because the numbers we're looking at are frankly staggering. Gold just fell below $4,000 an ounce for the very first time since last November. And it's not just gold. Silver has completely crashed under $60. Think about that for a second. If you bought into the gold story at the absolute high back in January, you're sitting nearly 29% underwater right now. We are technically and undeniably in a bear market. So here's the massive question everyone is asking us right now. Is the gold tree just over? Did the great bull run of the last 2 years finally hit a wall? Well, our answer at Wright Research is a bit more nuanced than that, and honestly, a lot more interesting. Because when you look past the raw paper price and actually read what's driving this massive move, it really doesn't look like the death of a bull market. It looks like a reset. And as we know, resets create opportunities. So let's break this down. Section 1: The damage so far. And let's be totally honest about the scale of this move, because it has been absolutely brutal. Look at these peaks. Gold topped out in January 2026 at a record $5,600 an ounce. Today, it's trading below $4,000. That is a drop of nearly 29% from the absolute top. But silver? Silver has been even wilder. It hit $121 in January, and now it's sitting below $60. That's more than a 50% collapse from its peak. But that's classic silver for you. It's the high beta cousin that amplifies literally every single move in gold, whether it's up or down. Now, for most retail investors, a 20% fall is that psychological line where pure panic sets in. Well, that line has been crossed, and sentiment has flipped, and it's flipped hard. But here's the critical thing that a momentum trader usually misses, and a macro strategist catches right away. A price falling, it actually tells you nothing on its own. What really matters is why it's falling. And the reasons for this particular crash are highly specific. Which brings us to the core driver in section 2, a Fed regime change. You see, the single biggest architect of this correction isn't fear. It's not a global crisis, and it's definitely not a crash in physical demand. It's the regime change at the Federal Reserve. The appointment of Kevin Morse to lead the central bank essentially flipped the entire policy stance on its head. The old regime, that was all about accommodation. Markets were aggressively pricing in rate cuts. But the Wash Fed is the exact opposite. They are strictly restrictive. Their mantra is higher for longer, and they are dead serious about it. Now remember, gold pays you nothing. There's no coupon, no dividend, no yield. When interest rates are expected to fall, that's totally fine. The opportunity cost of holding gold is super low. But when rates are staying high, every single dollar parked in non yielding bullion is a dollar that's not earning a safe return somewhere else. That right there is the core mechanism crushing the price. Digging a bit deeper, there are actually three distinct macroeconomic forces stacking on top of each other right now. Let's look at them. Force number one: the higher for longer mandate is very real. In the latest policy meeting, the Fed's median projection for the end of 2026 came in at 3.8%. And get this, 9 out of 18 officials now expect even further rate hikes this year. That is an incredibly hawkish dot plot, and it directly eats away at the appeal of gold. Then force number two is the US dollar itself. The dollar has surged to a 13-month high. Since gold is priced in dollars, a stronger dollar mechanically makes gold way more expensive for literally everyone outside the US. That naturally strangles international demand. And then there's force number three. And honestly, this is the one most people are completely missing: the yen carry trade unwind. Here's how it works. As Japanese rates rise and the dollar yen pair slides toward a 40-year low, traders who borrowed cheap yen to buy other assets are getting forced out of those positions. When you get hit with a margin call, you sell what you can, not what you want to. Gold and silver are highly liquid, so they're the first to get dumped. Not because anyone is doubting the long term value of gold, but simply to cover massive losses somewhere else. It's a forced liquidation, a totally temporary technical pressure on the market. But did you notice what's not on this list? Geopolitics. The Iran tensions that drove a massive chunk of the 2025 rally. They are still very much there. But right now, Fed policy is completely and utterly overshadowing geopolitical risk. And that is a huge clue for us. The selling is all about monetary policy and the dollar. It is absolutely not about the world suddenly becoming a safer place. So, what does this all mean for us locally? Let's move to section 3, the India portfolio impact, because this matters way more for Indian portfolios than a simple US dollar chart might suggest. Let's start with a really fascinating signal straight from our own market. Gold on the MCX fell only about 22% compared to that steep 29% fall internationally. Why such a actually buffered our domestic physical prices? So the Indian gold holder has genuinely been cushioned relative to the global investor. It's a quiet little reminder that local policy can absolutely put a floor under local prices even when the rest of the world is in a selling frenzy. Next, we have to look at the credit angle, because this is where the real equity risk sits for you and me. Think about gold loan companies like Monoprem Finance or IIFL Finance. They lend money against pledged jewelry. So, when the value of that collateral drops as sharply as it just did, you start seeing genuine loan recovery concerns. The pressure has even spread to producers like Hindustan Zinc, which has already seen its share price slip around 3.5%. And that's exactly why this isn't just a commodity story. It's fundamentally a financial story. If you hold gold loan and BFCs or metal producers, this massive correction is showing up in your portfolio right now, whether or not you own a single gram of physical gold. Producers tell a different story, one of unprecedented margins. Here's the part that reframes the whole panic. Seriously, look at the people who actually mine this stuff. Even after the fall, the economics for disciplined producers are, frankly, excellent. I mean, Integra Resources is running a massive 40% operating margin right now, realizing prices near $4,854 an ounce. Think about that. And they aren't alone. Sarabi Gold is doing the exact same kind of thing. They are funding the entire growth strictly from operations and have literally retired their debt. No shareholder dilution needed whatsoever. Let that sink in. Read that again if you have to. The price floor we've fallen to is still high enough for well run miners to print 40% margins and self fund their expansion. Guys, this is absolutely not an industry in distress. It's an industry that had a spectacular year, gave some back, and is still extremely profitable. When producers are this healthy at the very bottom of a correction, that tells you for sure that the structural demand underneath the price hasn't broken. So, where does this all go? Well, the latest Horizon SFA forecasts point to consolidation phase lasting for a few months, with gold basically ranging between roughly $3,750 and $5,000 an ounce. In plain terms, just expect gold to move sideways for a little while as the market digests this hawkish turn from the Fed. It's not a crash to zero, okay? It's just a grind. And that takes us to part 3, three structural supports or the floor underneath. Because underneath all that sideways grinding, there are 3 unbreakable structural supports still firmly in place. And they are completely insulated from all this short term retail anxiety. First up, de dollarization. This is the big one. Central banks are still buying. In Q1 2026 alone, they added a net 244 tons to their reserves. That's the 10th time in 11 quarters that central bank purchases topped 200 tons. Now, this is the most important point in the entire explainer, so really let it land. Official sector buyers are largely indifferent to interest rates. They're not day trading the Fed, they're diversifying away from the dollar and hedging against sanction risk. In fact, 43% of central banks surveyed plan to increase their gold holdings while actively cutting their dollar exposure in the coming years. Honestly, that provides a structurally higher flow than retail demand could ever provide. Second support is fiscal dominance. I mean, budget deficits in the US and Europe just keep ballooning. At some point, even a hawkish, wash led Fed might be forced to let inflation run above that 2% target just to shrink the real debt burden. And the moment that happens, you're back in a negative real rate environment, which historically is absolute rocket fuel for gold. And the third support, recession signals. The US Treasury yield curve has been uninverted for over a year now, and the labor market is definitely weakening. That specific combination has a serious track record of preceding recessions, making a downturn into late 2026 a very live risk. A genuine recession would force the Fed to reverse course, and gold would be the very first asset to sniff that out. Now let's pivot to part 4. Silver and the AI surprise are oddballs. Just a quick word on silver here, because honestly, it's a totally different animal. Silver is constantly torn between two identities. It's a high beta investment metal, but it's also a critical industrial input. The forecast range is basically $43 to $62 for the rest of 2026. The big drag right now? Solar. High prices have actually pushed manufacturers to thrift, basically figuring out how to use less silver per solar cell. Couple that with Chinese installations projected to grow only about 1% this year, and well, that kind of caps the demand story for now. But, and this is wild, there's a fascinating signal hiding in the platinum group metals. Look at ruthenium. It's this tiny, really obscure PGM, but it is seeing incredibly strong demand from the massive AI data center build-out. Why? Because the current dominant hard drive technology, MAMR, heavily relies on it for high density storage. It's just a crazy little reminder that this whole AI capex wave is quietly leaving its fingerprints in the strangest, most unexpected corners of the commodity complex. Finally, we arrive at part 5, the accumulation window and your investor playbook. So let's bring it all together. The paper price out there is reflecting one thing and one thing only: short term Fed repricing. Yes, the hawkish regime change, the dollar surge, the yen unwind, those are real. But they are strictly monetary and technical. They are absolutely not a verdict on gold's long term role. Underneath it all, the structural case is fully intact. Central banks are buying with price insensitive demand. Fiscal deficits are completely unsustainable. Real rates could very well turn negative again. And the producers? They are still wildly profitable at these levels. For the disciplined investor, that exact combination spells two words: accumulation window. But how you do it really matters here. ETFs remain your cleanest route for liquidity and transparency. Staggered SIPs, they are the single best tool for averaging your cost down through a sideways choppy phase just like this one. You really don't need to time the bottom. You just need to keep buying through it. Oh, and physical jewelry. Frankly, that is the least efficient way to express this view right now, especially with retail prices and making charges where they are. So, our base case for the rest of 2026 is sustained consolidation. We're talking sideways movement for several months while the Fed's hawkish shift gets fully absorbed by the market. But as those rate hike fears peak and fiscal dominance concerns come roaring back onto the scene, we fully expect the primary bull market to resume in late 2026 or early 2027. Look, the short term volatility is incredibly loud right now, but the structural case for gold as a core reserve asset has, if anything, literally never been stronger. So we'll leave you with this final thought to chew on. Are you going to let the media's noise blind you, or will you actually take advantage of this accumulation window? Thanks for learning with us today, and we'll see you in the next explainer. Let's jump straight into this explainer because the